Okay. Hello and welcome to ET Market Smart Talk. Well, I'm your host, Shatajanan, and today we have with us Churchill Bhatt, who is Executive Vice President of Investment at Kotak Mahindra Life Insurance, to discuss the recent RBI policy framework and the key indicators that could potentially trigger rate cuts in the near future. Welcome, Churchill, and thanks for joining us.
Thank you, Kshitij, for having me on the show. It's a pleasure.
Thank you so much for taking the time out. And Churchill, let's start with the recent RBI policy announcement. And well, there were no rate cut, but analysts have been picking up on some, something in the framework. And there were 22 measures which was announced. So, what's your take on the latest policy stance?
So there are two aspects to the RBI policy. One is obviously the decision on the policy repo rate and the economic impact that has thereof. The other is obviously they have also started publishing a set of regulatory, developments, statement of regulatory developments and measures separately. This time, apparently, both are pleasantly surprising. So first, let's start with the policy. The policy was, if you look at it on the face of it, a no change policy. Not really much happened to the policy rates. But the key difference between, say, past policy, at least the August policy and the October policy, remains that RBI has admitted to the fact that some policy space has opened up for easing. Now, this is a significant statement for any player in the interest rates market. Many believe that RBI will now await for further conducive developments, etc., before delivering a rate cut. Market participants are at least expecting more benign policy action than any untowardly or a hike or a tightening in the near term. In our view, RBI, from the phrase earlier in the past couple of policies where they had limited room for easing, have now moved to saying they have space opened up for easing. And which to us means that really no material changes are required for them to deliver a rate cut, for as long as the story as they see it pans out. The rate cut should be delivered because the space has already opened up. And the only reason why they may be wanting to wait and watch a bit is because they are waiting for a more fuller transmission of the 100 basis point rate cuts that they have delivered since Feb, and maybe wanting some more clarity on the global trade uncertainties, although I believe it may or may not come by the time we are in December.
Absolutely. Good that you talked about the rate cut because, let me also get your perspective on the stance, which is neutral, and the dovish pause, you could say that leave the door open for future rate cuts. What indicators or developments would you look for that could trigger such a move in the near future?
So, like I said, RBI currently has given us a narrative of a moderate slowdown in growth. Although the full year FY26 GDP has been revised upward to 6.8%, it is largely an impact of the first two quarters, which has already transpired and is now past. If you look at their projections of FY26 quarter 3 and quarter 4, the GDP projections are now 6.3 and 6.2 respectively. This year, this financial year, they've also revised down their inflation projections substantially. So in the April policy, the FY26 GDP forecast, the CPI forecast was closer to 4%. It was then revised down to 3.7 odd in June and then 3.1 in August. And now I think it is closer to 2.5, 2.6%. So this is a substantial mark down in their projections of inflation as well. The Q3 CPI, forward-looking CPI, continues to remain below 2%, while the Q4 probably hovers up closer to 4%. So if you look at the overall picture, what RBI is saying is CPI is well contained. In fact, it has
mm,
positively surprised them. So the inflation is at least not a worry at this point in time. And while the growth has done well in the past, or better than what probably they expected the growth to do in the past, the
mm.
forthcoming quarters are going to be a moderate disappointment.
Okay.
Uh, Given the mix, I think they're trying to say that some space is opened up. The inflation and growth both have given them some
Mm,
space to act
mm.
going forward.
Okay.
So the only thing that can derail this trajectory is a major development which on either growth or inflation derails the narrative. So we're not
Mm,
looking for any incremental narrative for the expectation of rate cut to materialize. We are
right.
simply looking at the current narrative to continue, and no impediment or surprises to derail the narrative, and the rate cut in our opinion will be delivered in the
Mm.
upcoming policy.
All right. That's so one rate cut is a possibility in the December month, right? In fact, you did, I think, touch upon the lower CPI expectation as well as lower CPI front. That's what RBI is guided for, and the growth number has already been raised to 6.8%. Uh, uh, and this could actually impact, or this could actually influence the rate cut move. And you already, pointed out that December could be a month wherein we could see a marginal or 25 basis point kind of a rate cut, or any rate cut, which is a possibility. Let me also move to my next question, because I was pointing towards this only. So let's talk about the M&A financing. Can you also elaborate on the recent banking sector reforms, especially the framework for the M&A financing and the financing against listed debt securities, and how will these changes impact corporate borrowing and investment flows?
Sure. So see, like I said, there was a host of, in fact, if I'm not wrong, 22 various
Hmm.
measures taken on the regulatory development sides.
Yes.
Some of the significant ones are obviously, so banks after a few decades will now be permitted to finance M&A transaction. See,
Hmm.
banks are the largest financiers of the credit in the economy. In Indian market too, they are probably 190 odd lakh crores on their loan book size, which is a fairly large number. And this space up till now was not opened up to them. So it was possibly the non-banking players in either the NBFC form or the foreign players, or in some cases
Hmm.
maybe some AIFs or other structured finance players who were participating in this set of transactions, who were financing these set of transactions. Uh,
Hmm.
I think RBI has rightly opened up this space. See, this is a fairly large space. In a good year, we can see transactions upwards of almost $100 billion
Hmm.
financing M&As. And this
Right.
space should be and is thankfully going to be opened up for the bank. It's good for the borrowers. The more the number of lenders, the more efficient the market becomes. Uh,
Hmm.
Also, in the traded credit space in India, fortunately or unfortunately, the market remains fairly liquid for relatively higher rated credits. So maybe
Okay.
double A space and better
Hmm.
are the credits which get financed easily through the non-banking traded space. For any lower rated borrower, the
Hmm.
transactions become slightly difficult because the market shrinks. We
Hmm.
believe that these kind of reforms which allow banks to step in will also encourage M&As in corporates which are of relatively lower credit rating,
Hmm.
because that's a space which banks understand quite well. Uh,
Okay.
a large portion of their loan books and relationships remain in that space, and so it's
Hmm.
a welcome move. On a structural basis, I think it makes the markets more efficient. Uh, a few other measures
Absolutely.
like
Now, with improved access
lowering.
to fixed income
Yeah,
and
sure.
corporate bonds, what opportunities do you see?
So see, on the fixed
Right.
income and corporate bond space, one of the opportunities which has opened up again is
Mm-hmm.
RBI has removed restrictions on borrowing against listed NCDs. Now, obviously, finer details are awaited both on the M&A
Mm-hmm.
side as well as multiple other set of regulations. But what this does is, again, let us say that if I am a relatively lower rated entity, I'm an upcoming entity, I'm a new business entity, I may not have an established track record of borrowing, but I
Mm-hmm.
am on account of my treasury, on account of the financing that I receive, I'm holder of good quality, say AAA rated NCDs or traded instruments.
Right,
Today,
right.
these instruments are something which lie in my book largely as investments. If the
Mm-hmm.
regulations are I'd say one as and when the regulations are out, these securities can be used as collateral against which I can go and borrow money to finance my otherwise business enhancing activities.
Right.
And because these instruments which I hold are maybe of better rated entities than my own rating, my financing would be cheaper, more easier for a lender to take a credit call with such a collateral as an underlying. So it again
Mm-hmm.
deepens the market. So what it basically does is, more lenders can participate, more borrowers can enter the market, and the overall efficiency of the system goes up. What was otherwise only an income earning asset becomes now an asset against which I can even raise financing.
Right.
So more asset creation, more economic activity, overall good for the country.
Right. So win-win situation. That's the best thing to have. And finally, let's also get your perspective. How is fixed income expected to perform in the next 12 months or so?
So again, we're now at a stage where we believe that while some policy space has opened up and the overall
Mm.
macroeconomic environment remains fairly supportive of fixed income assets, uh,
Right.
the incremental room for further policy easing may not be much. Uh,
Okay.
so unless we see a major global shock or a more widespread slowdown, either locally or globally or both, we
Mm.
believe
Mm.
that while there is room for more policy easing, it remains limited to at best 25 to 50 basis points. Uh,
Okay.
and so to that extent, we are of the opinion that while there is some room for the yields to move lower, the room may
Mm.
or may not be abandoned depending on how the global macro and the local macro shape. Having said that, this remains an environment which is conducive to fixed income. We believe that relative valuation wise, fixed income remains a cheaper asset class as an alternative compared to the rest
Mm.
of the alternatives.
Right.
And so it will remain an asset class of choice. It has a space in everyone's portfolio, and it is
Mm.
expected to perform well at least over the next 15 odd months. And thereafter, we'll obviously have to take the upcoming data into account to see where the direction of the overall policy and the rates are headed. But it looks like good times for fixed income, better than average returns, and some space for fixed income in anyone's portfolio, probably a good time for that now.
All right. So good time coming in for fixed income. Message coming from Churchill. Well, on that note, thank you so much for taking the time out and sharing your insights on RBI policy, growth, inflation, and investment opportunities. Again, thank you so much for your time, Churchill.
Thank you, Kshita. It's been a pleasure.